Hey, welcome back to the Art of SBA Lending. This is part 2 of the State of Small Business panel. In part 1, we talked about default rates, deferments, how to handle deferment requests. And here in part 2, we're going to talk a little bit more about servicing, but then we're going to pivot into the originations and what changes these guys made in their practices to mitigate any sort of concerns they were seeing in their portfolios, as well as kind of talk about the future, what their predictions are. And you know how bankers just love giving predictions. So stick around, stay tuned. I hope you enjoyed this part 2 of the State of Small Business panel. It's no secret that most entrepreneurs are busy, and getting them to focus on their underwriting checklist is a full-time job. So when it comes to the business plan, projections, and assumptions, I'm a huge proponent of bringing in an expert. Rapid Business Plans is a trusted partner to small business lenders and their borrowers. They make it easy for entrepreneurs to tell their story in a format bankers love. Their team goes the extra mile to ensure everything is done fast and done right. And they're all based here in the US with employees across 4 different time zones. They just completed an export business plan for one of my borrowers, and they were super happy. We got their CRE expansion loan approved, and now they can move forward in their business with a clear plan. Rapid also offers feasibility studies, which I highly recommend for any independent startup loan. So go to rapidbusinessplans.com for more information and set up your Get Acquainted call today. I'll leave a link in the show notes below. Jordan, let's talk about industries. What industries have you noticed are doing exceptionally poorly right now? And, flip side, what industries are doing well?
I hate to give you a non-answer answer here, but I'll tell you that we may not be the best one to tell you about that because we're such generalists that we don't really have a concentration enough of a sample size, I would say, in any particular industry to tell you, wow, this one's just doing horribly. And I think Bill had mentioned it in an answer earlier that there doesn't seem to be any kind of systemic issue in any one industry that we could point to. We've got, and this is just recent for us, we've got lists of industries that we consider we're encouraged and discouraged to lend towards, but we don't have any that are full stop, will not do, and we certainly don't have any that are just rubber stamp approvals. Our bank is very much generalist, and if you were a fly on the wall of one of our Monday calls when our lenders go over what they're looking at, it's always interesting to hear just the broad range of businesses. So I don't know that I could point to any one thing and say, this has just been an absolute disaster. And I think, again, that goes back to the very first point, which is how resilient everything's been. I think there were industries that we all looked at and said, this one's really going to struggle this year, maybe discretionary businesses that are based off discretionary spending and all that. And somehow they've still marched on. So I hate to give you a non-answer, but I really can't point to any one particular other than industries that we kind of shy away from. And again, that's more of just particular one-off cases we've had that it seems to add up to a couple of them. And we say, maybe that's an industry we want to kind of, be cautious towards, but nothing that I would say are just absolute disasters.
I'd like to piggyback on that a little bit. Jordan said something that, we're being very mindful of right now. And that's businesses that are either in an industry that is very discretionary income focused or in geographic areas that are very discretionary income focused. And one of the reasons why is in the research that I do on a regular basis for the bank, watching the savings rates, they're starting to tick back up again. And as the savings rate goes up, that's typically an indicator that people are saving money because they think a recession or they think bad things are coming. If you look at the savings rate right as COVID hit, it went to like 30% or something like that. It was crazy because nobody knew what was going to happen. Nobody was spending any money. It dropped below the average last year, the year before, and it's starting to tick back up above the historical average. A lot of those COVID dollars are finally finding their way out of the system now. So there's not as much actual cash in savings accounts anymore. So if interest rates continue to stay high for long periods of time, and that discretionary income or that discretionary spending starts to decrease, that's kind of one of the areas I'm keeping my eye on a go forward basis, and watching probably closer than any specific industry.
So in Florida, where I am, and Jordan, you're down here in Florida, right? And
Mm-hmm.
Nick, I'm sure you do a lot of deals down here in Florida. You got
We
many
do.
in Florida, and everyone seems to lend in Florida. It just seems to be like all the SBA deals that get done in Florida come from lenders all over, local and across the country. So Florida is doing pretty well overall, and maybe it was doing really well these last couple of years. You guys see deals now on the origination side where, remember all those COVID boom businesses? You had e-commerce, but you also had like home improvement type of businesses. And, there was this built up demand, after COVID that made 2021 a really good year for those businesses. And because the backlogs were so long for those home improvement types of businesses, construction companies, people trying to, improve their house, the backlogs came in and those jobs were booked all the way into 2022. And then you start seeing a cool down in 2023. Have you noticed any trends with regards to those profiles of borrowers?
I'll jump in and give you more of a non-answer answer as well. But, I think one thing I think about in that is not necessarily the home improvement, but was the nurseries and like the outdoor backyard. I mean, you couldn't get anybody to come to your house pretty much anywhere in the country for 6 months, 9 months, 12 months. And Ray, I know you did an expansion in your backyard, and I'm sure that was fun scheduling. I did some additional stuff in my backyard as well, and I mean I was on a wait list for quite some time, but now I can call somebody and get them right out. So that's one place I think that's definitely changed. We tend to look at more when we're underwriting long-term businesses as opposed to flash in the pan, or this industry is having a jump, and what's going to be the long-term outcome of that industry is more how we look at it.
Yeah, on the construction side, Ray, one of the things that we're always mindful of is what's their mix of new construction versus remodel or renovation, if it's a general contractor or even if it's a sub. Talk about the trades. The example we use in Florida here is if an HVAC company. If they're doing a lot of new construction, that's one we're probably going to hedge against a little bit, just, understanding that at some point that's going to continue to slow down. It already has slowed down some depending on where you live. But in Florida, if your AC goes out in the summer, you're replacing your air conditioning no matter what the economy is doing. Economy is good, economy is bad. You can't live without an air conditioner in the summer in Florida. So, are they ones who do a lot of, maintenance work and installations in existing homes, or are they ones who are really focused on new construction? That's where we've kind of broken it down to answer your question on the construction side. And the home improvement side is what's the breakdown of new construction versus maintenance or repair.
Yeah, that works in Little Rock and Dallas too, I think.
Yeah,
absolutely. When it's 105 in Dallas, you want your AC working.
Yeah.
Have your guys' ACs broke recently? I had an AC break a couple years ago, and in Florida in the summer, and I keep the thermostat at 75, and by the time the AC guy told me we're going to need a new unit, the temperature was already in the 80s, and it was 4 p.m. and you can't sleep right without AC. So I had to, but my unit was only 7 years old, so I was like, why does it need to be replaced? Long story short, it didn't, and I don't like that company anymore, and we fixed it, and it's worked fine ever since. But yeah, I love the HVAC industry. It's probably one of my favorite industries to lend to. So going back to when we thought early in 2023, when we thought we might have some bigger problems, and I guess it sounds like it ended up being, did you do anything on the servicing side to protect the bank against risk? Did you implement anything new earlier, going back about a year, in preparation for maybe what could have possibly happened at the end of this year or sometime this year?
Lots of conversations with our staff. A lot of my servicing staff is on the younger end of things, and They don't remember some of the issues that we had back in the 90s or early 2000s. Um, so yeah, there was a lot of conversations in prepping the staff for, hey, these are the things I want you to look out for. We've had 10 years of, artificially low interest rates, and, here's red flag indicators that we need to keep an
Mm-hmm.
eye on that you might not think about. Aside from that, we did change some other internal processes and procedures, but the big thing was, education on the staff so that they knew what to look for.
Yeah, I think our biggest move was just to let our servicing folks know to reach out to your customers and reach out to them often. Even if you don't need anything, just call and see how they're doing, check on them. You know, make small talk, see if you can get them to tell you anything as far as the business goes, any issues, things like that. Just so you can go ahead and you know get ahead of it and
Communicate. That was kind
yeah.
of what our message was. We didn't really implement any new processes or prepare. Just communicate and stay steadfast with the annual reviews. That was sort of our plan.
I feel like 2023 was the year of the servicing team. So, I do want to thank the SBA servicing community, because you had more deferment requests than you would have in recent years. So you're busier. You have maybe more payoffs, right, with rates going up.
Mm-hmm.
By the way, did anyone see a spike in payoffs?
Yes.
Oh yeah.
Yeah.
Why was that?
I'd say probably of all the reasons that stand out, borrowers with real estate that were able to refinance because they built up equity, and I just couldn't compete with a multi-billion-dollar, national bank on pricing because they were still offering, in a lot of cases, some rates that were just below Fed funds rates and on fixed rate real estate loans for a period of time. That was where most of ours came from, were real estate refinances.
Yep, same. We run a pretty heavy real estate portfolio and just rates and
I don't know if you all saw this. It seemed like for us, we saw more of the payoffs in the earlier part of the year when rates were still rising, and the conventional banks, conventional lenders hadn't necessarily increased their rates up into what they are now. There seemed to be a lag there. The Fed was raising rates quicker than the conventional banks necessarily were. And so our borrowers were getting out, but then it kind of leveled off, and the conventional banks seem to have caught up, and there's maybe not as big of a delta there between SBA rates and conventional rates as there were maybe 9 or 10 months ago. It felt like the speed of the payoff slowed down as the year went on.
Yeah, I'd agree with that, and I think part of it too is what were the bank's funding sources.
Yeah.
If and how fast did they have to increase rates that they're paying on CDs or depository accounts, or where's your funding coming from, kind of thing. If we're competing with one of the four largest banks in the country, they've got so many billions of dollars on deposits that they can compete on rate that we just can't, kind of thing. But I think as the year went on, and the banks caught up with what they were having to pay on depository accounts, I think that's where some of that lag was at. I know we've had a lot of conversations with borrowers now that, hey, everything looks like it's at the top of the rates now. So hold on, because if the Fed starts decreasing rates, then your variable rate loan is going to go back down, and it doesn't make a lot of sense for them to necessarily go refinance at a fixed rate right now. So I think it's a combination of those two things.
Yeah, I would also add one other prong is, I think a lot of the large banks don't use prime as an index when they're pricing loans. They use LIBOR, SOFR, not LIBOR anymore, but did, and treasuries, and they had already priced in the increases for the most part. Treasuries were 3 to 6 months ahead of prime in their, the rise. So, they're using their basis on that. And
yeah, good point.
Yeah.
Bill, was there anything that you learned through your portfolio that you said, and then implemented on the origination side last year, where it's like, hey, maybe we need to turn the dial here or here because we're seeing this going forward as you're lending?
Not anything major. I think, we did small tweaks. I think it was July of 22. We'd always done an interest rate sensitivity analysis up to 3%. I think July of 22, I told my staff to go up to 4%. And even that was obviously a little bit low. But we started that early on and really was looking at it the latter half of last year. Aside from that, no, I wouldn't say there was anything significant we did. It was little tweaks here and there on some things, but nothing significant.
Yeah, I'm trying to think what else would we have done. I mean, essentially, no. Do you guys anything on your guys' end to add into that, or should we move to the next topic?
We revised some guidelines towards the end of the year, and that was just as much a function of what we're seeing in the portfolio as just competitive reasons, just what's going on in the marketplace in terms of origination. That caused us to revise some guidelines. And you mentioned turning the dial. One of the things that was interesting and we saw in our portfolio was that hotel loans have been doing better, I think, than we anticipated, and that was an area we'd always shied away from. And so that's something we've sort of maybe opened up that was an unexpected surprise. We had always been told, really cherry pick the hotel deals, and then it turns out hotels were pretty good.
Mm-hmm.
Tourism and travel was strong in 23, and so that's an area that we've actually kind of opened up that was unexpected.
Yeah, hotels always get a bad rap, but when I look at the data, I was looking at some Lumos data the other day, and they have a low default rate, but certainly they got crushed, in many cycles of the economy, obviously most recently COVID, but they pay. I don't know what it is.
Yeah.
I'm not really a hotel expert, I will admit that. I think there's about to be a big problem for a lot of banks. We're all spread so thin, only once we know of a problem in the portfolio do we put resources on it. We are reactive, not proactive. But I have good news. Our friends at Lumos have a way to score the loans in your portfolio so you can see which loans have a higher chance of having problems, so you can get out in front and help prevent defaults before they occur. Their analysis will provide an overview of your predicted portfolio performance, allowing you to analyze the data on all sorts of levels. You can look at the portfolio as a whole, or by subcategories like industry or geography, or you can go loan by loan and look at the predicted expected loss and probability of default. And you can track these numbers over time so you can start to see trends in your portfolio. Now you have no excuse. You can finally take care of your portfolio the way you should be without having to hire a team of analysts, because Lumos did that for you. Go to lumosdata.com for more information. So I like that we're kind of pivoting the conversations towards the origination, right? Because we looked back at last year and we're kind of talking through it, and the word that Bill said gives me flashbacks to every economist I listened to from like 2017 to like 2019, which was cautiously optimistic, I think is what you said.
Yeah.
It's like their favorite phrase, right? And so going into the originations, like what problems are we seeing? When we're looking at new deals now, Jordan, what types of problems are you seeing where it's like this deal just doesn't make sense?
Well, we're still, not seeing as much real estate transactions. I think those are still tough. I think there's still a bit of a disconnect between what sellers are wanting to pay and what they can afford with the current, debt market versus what the buyers want. Similar to what's on the residential side and how down that is. I think we're still seeing challenges there. But I would say that's probably the most common, whether it's real estate or not. The most common challenge we're seeing is from a cash flow standpoint, businesses or real estate, sellers expecting a certain return that's just not capable when you include 10 or 10.5 or whatever rate, variable rate a borrower is getting charged right now. The math just doesn't work. I think we're seeing that.
So a valuation gap. Now, is that because, I just want to unpack that a little bit further. Are they bringing deals that are essentially signed LOIs where the buyer and seller have agreed to a deal and the bank can't get behind it because it's too skinny, or their math on valuation is based on the last 3 months of really good months or something like that, and we're looking at last 3 years. And so is it a function of buyers and sellers not coming together, or the bank just not being able to get on board?
I think in most of these cases, at least the ones I'm talking about, they're more almost pre-LOI, discussion, and the seller saying, I want X for the business, and the borrower's coming to us and we're running the numbers going, it doesn't cash flow. I mean, they're going to have to hold a really large seller note on Sam. I mean, there's something's going to have to happen for this deal to work. I think that's that. I'm not saying that's every deal. There's certainly sellers who've adjusted and understand, and obviously, Ray, you do a lot of business acquisition financing, so they're getting done. I'm not saying this is universal or widespread, but I think it's probably one of the biggest hurdles we're facing is that kind of disconnect and the inability to make it cash flow at the current rates.
Yeah, that's part of it. And as interest rates go up, the return somebody would expect from an investment changes also. And so we've seen some valuations on businesses not come in quite as high as what the seller was hoping to get, because a change in rates changes an investment profile, and it'll change a valuation. If it's close enough, maybe the borrower can come in with that delta. In a couple of cases, it was so far out of line that we couldn't make it work. Not because we didn't want to, just there wasn't enough cash to cover the delta.
Yeah, we've seen that even on the real estate side for the most part. I think even maybe in the last, I would probably say 30, 45 days, I've started seeing the real estate prices, valuations get back in line a little bit more. A lot of folks were still thinking that the real estate values were the same as they were during COVID, when the world was full of liquidity and everybody was trying to move into the investment market. But I'm starting to see cap rates come up some, and some sellers that have been holding for a while start to get a little more realistic on price reductions, things like that. I mean, when your rates double, prices have to come down.
Well, I agree with that, Jordan, what you said too on the business acquisition side, because there is a little bit of a gap, at least this past year, and it's creating more deal fallout. So like if the buyer can stretch to get there and the seller can stretch to, meet the buyer at that number under those terms, it's like such a fragile transaction. Any little thing that gets uncovered maybe in due diligence on the buyer side, and it's like, okay, well, the business doesn't have that much SDE. I just found out this, and now we got to lower the price by X. The seller's gonna bail. Whereas, a couple years ago, they're selling on a high, and buyers have no, 0% interest rates or whatever, or 5-6% in the SBA world. It's like, and incentives in 2021, right? Free money. It's like these deals were just going. I mean, I think I had no deal fallout in like 2021, whereas now you're seeing a little more than average for me over the, based on what I've been doing the past decade. So we'll see. I guess we'll see what happens this year, right?
I would guess more in y'all's world of business acquisition, we don't do a whole lot, but businesses probably levered up quite a bit when they could, when debt was cheap, and that just doesn't work out for sellers unless it's at X price.
Well, it'll be interesting if we get any kind of, economic pullback, or maybe even a minor recession of some sort. It'll be interesting with these businesses in 23 that were, to your point, Ray, stretching, and now it turns out this individual might have bought it at the peak of the market. If there's a little bit of a pullback, that'll be interesting to see how that plays out.
Oh, for sure. Now, Nick, you do you do a good amount of construction lending, right?
We do. Yes, sir.
He's got a hard hat right behind him.
Yeah, he does.
Oh, yeah, that's right.
He's got one on the ready. Yeah.
That was from one of our buildings, but yeah.
How has that been going? Did we get past that whole phase where, the prices of construction kept going up? Yeah. Have they come down at all?
Come down a little bit. I wouldn't say a lot. But what has come in line is, we definitely had some projects that were going on during that 21-22 timeframe. And man, they just took 24 months to get done. They were over budget. They were this, they were that. Luckily, valuations have kept up with them, so we've been able to we've had to make some additional loans, to your point, just for cost overruns, etc. But fortunately, we only had a few of those, So monitoring, knowing it up front, knowing it quick, knowing, what was going on. The businesses have done well enough to continue to cash flow the credit. So that was helpful. But at this point, I mean, everything seems to be kind of back to schedule. Everybody's hitting costs. I've had a few come in under budget, which is always nice. It's a rarity, but
Yeah.
We haven't seen any of that.
yeah, I've had one or two. That's about it.
Send some of those Arkansas builders down to Florida. We'd like that.
Yeah, no kidding.
Hey, did you guys see that whole, increased demand that we were kind of forecasting during 2020, 2021 as SBA took center stage during the whole small business crisis and PPP, and that exposure that, we got as SBA lenders? Are we seeing that come to fruition now at all?
I certainly think the brand awareness of SBA is more than it's ever been. And I think that's largely due to PPP. When I think of pre-COVID times and I would tell somebody I was an SBA lender, it was 50-50, maybe even less than 50-50 if they had ever heard of SBA. That's definitely changed. I think there's much more brand awareness now for the term SBA and what we offer.
Yeah, and the other piece of that is that the people that had heard SBA before, especially if they'd been around for a couple of decades, thought about the SBA from 20 or 25 years ago, and it's so hard to deal with. But they've figured out that, okay, this process isn't all that much different from getting a conventional loan at this point. Now, if we could just get the SBA systems to get rid of these hold codes and whatnot, I think we'd all be happier. But yeah, to Jordan's point, I think the brand awareness and people realizing that, hey, this really isn't that much different than any other loan. There might be a couple of additional pieces of information, has helped immensely.
One of the things I noticed is, I thought initially it might be a bad thing, but now I'm thinking it's probably a good thing, is that some of these banks that had never been exposed to SBA or whatnot have figured out, this is a good line of business and they want to get in it. But what I'm seeing is they're doing it the right way. They're hiring experienced folks. They're not just trying to do one or two here and there. They're building a team of staff around it. And that's really what helps. In Arkansas, SBA had I will say, a not stellar reputation when you would mention it because, it's just not a big SBA state. So there was no players that really churned these deals out and had a team built out to do this. So the borrower's experience probably wasn't pleasant. The banker they were working with was probably a conventional lender that didn't know what they were doing, and so I think that's changed.
I was trying to avoid the hold code discussion, Bill, but you're tempting me. But so. Is volume year over year SBA volume up or down for each of you guys? Jordan, do you know off the top of your head, not to put you on the spot, but were you up or down in 23?
23 was actually down for us from 22. And that was mostly by design, us trying to ease up as we were navigating the uncertain economic times.
Okay. Well, I know you're still up there in the rankings, so you're definitely still making loans, but is the year 22, that was, I always get confused with the fiscal years, but the 2022, yeah, I'll figure it out later. So, okay. So slightly down for you said, Jordan. What about you, Bill?
We were up. If you're talking about for 23, we were up 23 over 22.
Yeah. Just count. I will go calendar year 23 over 22 just to keep it simple.
Yeah. We were up and we'll be up again for 24 also.
Oh, forecasting.
Wow. All right. Yeah.
There he goes.
I like it, Bill.
Hey, I got to start out positive, right?
Yeah.
Have to.
Well, I'll steal his line. We were up, but we were cautiously optimistic. We'll have an increase for 24.
Cool.
We're going to blow it out in 24.
There you go.
So, a question for you guys. I want to hear one lesson you learned in 2023, and I'm going to throw you a little curveball. It doesn't have to be about lending. Just one thing you learned about yourself, your leadership style, management, or lending in 2023. Who wants to go first?
I will. It's more personal for me and not really, it does pertain to work-life balance, but, be present where you are. don't constantly be checking your phone when you're at home with your kids or whatever. Put it down, put it away. That's the biggest thing for me. That's what I'm trying to work on for 24 is, just being more present. If I'm at work, be at work. If I'm at home, be at home, or whatever. So.
Excellent.
That's a really good one.
I was just going to echo Nick because as you asked that question, I'm like, gosh, what I'm going to answer. And I think Nick's spot on with that because I did a lot of that introspective in 23 as well, trying to stay off of social media. And I have other things that I do outside of my work life that forces me into it for some reasons. But yeah, being present, I think that's a great one, Nick.
I'll say in 23 and maybe even 21 and 20, you can probably go back every year. But I would say for me, it was expect the unexpected. I mean, what a year of just unexpected curve. You said curveball, Ray. Well, we got a lot of curveballs thrown at us. Who thought we'd wake up in, April, have had the 3 of the 4 largest, bank failures in the history of the U.S. happen in a several month period. And then who would have thought the SBA would put out an SOP that has some of the most sweeping changes we've ever seen in a single year. And then you got the geopolitical stuff going on outside of the country. I mean, there was just so many curveballs thrown at all of us as bankers, as a country, that expect the unexpected. We set out a plan in 23, just like we're talking about right now, what we're going to do in 24, but who knows what's around the corner. So you better be nimble and you better be able to react and respond.
As somebody who got into lending in 2011, you think about where we were in the economic cycle at that time through now, up until COVID, COVID was obviously that. And in Florida, especially, it was like, there was definitely a huge stumble and then it kind of shot up, then it exploded. So, it was a couple rough months, but ultimately it led to this explosion. So I learned that as I was going up every year, even through COVID, and then this year was my first down year, I learned you can have a down year. So that was a humbling experience for me. And I wish I would have saved some of my money. But anyway, so
now you're going to age date some of us that remember the 90s and the early 2000s.
If you do it long enough, you will have a down year.
Yes.
So I have a fun game. I don't know. Do you guys have a piece of paper handy and a pen?
Yeah.
Grab one.
Yeah, go grab one. I think you already know what I'm doing, Jordan, but I'll explain it to these guys. And, my question is going to be, what inning are we in the economic cycle? And then I want us to write it down and then put it up in front of the camera. If we can.
What I missed it. What's the game?
What inning are we in? Economic cycle.
You had to do innings, not quarters, huh?
Yeah. How many innings are there, by the way? I'm not big on sports.
There's 9.
9? Okay. Madison's laughing. I can tell behind the scenes. I knew there was.
So what inning of this economic cycle are we in?
Yeah. Just pick a number.
Oh. All right.
I'm doing it too. All right, ready? I don't think you wrote a number, Jordan. Did you write?
I did.
You wrote.
I don't have great handwriting.
Smiley face.
So.
Yeah, me either. That's what.
If any of you wrote cautiously optimistic, I'm gonna kill you. All right, ready? 1, 2, 3.
What was that?
3, 3. Can you just say yours?
He got specific on us.
Top
I can't
of
read.
Also, mine says bottom of the third.
So 3 of us had 3.
Wow. All right.
Yeah.
You're gonna have to tell the audience that we didn't plan that. That's just weird.
We did not plan that.
Okay. Well, 3 of us had 3. 1 said 6. But which one of us is CEO of a bank? So.
Yeah, exactly.
Nick probably knows stuff we don't know. All right. So we're gonna wrap it up here. I just want to try to I'm trying to think of a cool, creative way to get this question out here, but looking forward into 2024, I know we kind of mentioned that we're cautiously optimistic 2024 is going to be good. We're all planning on growth, but the rates take 2 years. So I want to ask it in a different way so we don't say the same thing. But what's one thing you're looking forward to in 2024?
I'll jump out there because probably be all of our answers, but rates coming down.
Agreed. Rates coming down.
I was going to say, I'm looking forward to hopefully more stability, less uncertainty than we had in 23.
Oh, well, isn't it an election year?
Yeah, so never mind. Scratch that. Rates going down.
So that just means it'll be stable through 11 months.
Yes.
Because nobody will want to change anything during the election year.
Yep. I'm
There you
hoping
go.
for more stability.
Anything anyone else want to add before we sign off?
No, I just want to say thank you to our servicing partners, as you mentioned, Ray. That was a wild year for them. So I want to give a shout out to my servicing team. Thank you all for everything you do.
Yes.
Well, Jordan's always got to one up us. So yeah, agreed. There's a lot of people that make this wheel go around, and that they're the unsung heroes, and the back end and back office and everybody that the originators always get the glory, right? But everybody else is actually what keeps it going.
Yeah, a lot of good people out there in the industry doing a lot of great things right now. So any of the lenders out there, back office, front office, whatever, just keep up the good work, folks. That's what keeps everybody going.
Well, this was a lot of fun, guys, and thank you so much for joining me.
Thank you, Ray.
That's it for the State of Small Business panel. Thank you all for watching. Until next time. All right, that's it for this week. Don't forget to subscribe to the podcast so you never miss an episode of The Art of SBA Lending. And if you have any feedback or suggestions, email me at ray@artofsba.com. Until next time, ta-ta.